Hi, and welcome to another episode of Nursing Your Way to Wealth, where a mental health nurse and an accountant talk about wealth creation, personal development, and financial independence in the UK to help you live the life you deserve.
Hello and welcome back. This is episode 69 of Nursing Your Way to Wealth. Today we're going to cover a little bit in depth about kind of company statements. This is more of an accountant, Alex Bagg. So I've decided I'd do the intro, a little bit about that, and then I'll pass to Alex for the majority of these things. But just as an introduction, this in the last week or two, I've been listening to another book on Audible called The Myth of Capitalism, which is about kind of competing companies, how companies grow and flourish and just find their way in the world. It's written by a chap called Jonathan Tepper and Denise Hearn. It's called The Myth of Capitalism, Monopolies and the Death of Competition. So it's about how the huge kind of household names that we all know, mostly in tech, etc., but other companies as well, how they compete to be the best of the best. And when like a disruptor company comes in, how they act and how they move to either prevent that company from kind of sprouting into like a plant, perhaps for a garden analogy, but also how they kind of work with them and then buy said company. So there's a lot of kind of buyouts happen in tech for the big overarching companies buy a lot of the smaller companies up and then use their tech as they go. So the bigger companies get bigger, and it's harder, I think, now for smaller companies to flourish. But I'm about halfway through the book. It's decent. I like it. I've learned quite a lot of stuff from it that I just didn't know. And the logic of it makes sense as well from that point of view. So, Alex, have you read The Myth of Capitalism or no?
I haven't, but it does sound good. And I think that what comes to my mind when you often think of big companies owning lots of things is if you go to the supermarket, I would probably guess a good three-quarters of all the products and brands that you see will be owned by maybe three or four companies, like between Procter and Gamble, like
Nestle.
Nestle, Colgate, L'Oreal, um, Unilever, like almost within a handful of companies, you will probably all of those brands will be made by those companies, and even like the kind of supermarket owned brands are manufactured by those same companies, but they have different labels and slightly different ingredients. And to your point of nobody really knows Procter and Gamble, but people will know Gillette, or people don't really know Unilever, but they'll know like Dove soap or Marmite, for example, which I think are made by Unilever, but please correct me if I'm wrong. And I think you almost peel back the layers, and it's suddenly anything in the cereal aisle is owned by Nestle, and Pepsi make all the drinks, and Coca-Cola the same, but also crisps and snacks. And you're really you probably got maybe 10 to 15 companies and multinational conglomerates who, even though there's thousands, if not tens of thousands of products available, you might think they're all very different, are owned by one ginormous umbrella. So yeah, I always think of it in that context.
Yeah, it's interesting, isn't it? Actually, when you do look at the back of some stuff, it will say that owned by this particular company. Like
Hmm.
Marmite is owned by Unilever, which
Ah,
is
good. Got that one.
yeah. I've just done some googling quickly, and apparently Unilever they own 400 global brands around
Yeah.
the world. So, and it's like there's a lot of it. Anything from like Ben and Jerry's,
Mm.
like ice cream, to Coleman's mustard. They'll make Domestos bleach, Cornettos, like Dove soap, as you said. They're also responsible for like Marmite pot noodle, washing up liquid from like Persil. That's yeah, all made by one company. And if you think about it, there's even like other food and stuff here as well. They own the vegetarian butcher and Tresemme. If you want
Mm.
dinner and shampoo in the same place, you can get it. But if you think about like the kind of the movements of producing shampoo and stuff like that, if for every brand you see, they're not going to have their own factory, their own kind of mixing equipment, their own bottling place, their own distribution. It's going to be one humongous place somewhere,
Mm.
just working with different ingredients. Because otherwise, there'd be factories absolutely all over the place, and the UK certainly wouldn't be 90% green land, would it?
Mm. Yeah, it is insane when you like start to peel it back and really understand. like you might see a company like, yeah, people probably have heard of Unilever or P&G, but might not really appreciate the breadth of brands and products that they actually sell. These are behemoths of companies.
Yeah, but absolutely huge. I mean, just thinking like Nestle, for example, they own nearly 23.5% of L'Oreal. If you think about Nestle, for me, I think about Kit Kats, to be honest. But they own, just like quickly, they own all of Nespresso, which is
Hmm.
like a huge company in its own right. But actually, that's a very small part of the Nestle overarching umbrella, which is crazy, actually. Yeah, when you think about it. Um, yeah, they own all sorts of stuff from like water and baby food to cereal to chocolate, confectionery, coffee, chilled and frozen food, dairy, ice cream, healthcare and nutrition. I did not know that. Um, yeah, I mean they kind of optify and thicken up. The stuff we use in a hospital to thicken fluids for people who have trouble swallowing so they don't choke. And that's all owned by Nestle and a load of pet food brands as well.
Yeah, quite quite the bag.
It is. It is. That's mental. I did not know all of that. Right. So that's the book I've been reading. You haven't read it. I've read a little bit of it. Yeah, we've realised that actually Unilever and Nestle basically own most things in the supermarket, except for probably fruit and veg. Who knows? Okay. So my return on heartbeats for this week is something I've been working on for probably the last 6 months or so. I've been having conversations with my employer, etc., to try and make this happen. And I finally got somewhere tangible with it. So in nursing at the moment, I work in the ADHD field. We give a lot of medicines to children and adults, etc., to help manage some of their symptoms. I've been wanting to do a prescribing course for quite a long time since I kind of started nursing, really. And things have kind of fallen into place. And I've been doing a load of forms this week and last week and getting signatures from the right people. And I've been given some funding from NHS England to start the course in September, which is great news for me. I just have to do the work now, which I can do. But what it means is, and why this is a good return on heartbeat, is because these forms are long and there's so much chasing and doing, there's so much learning that I now need to do. But what it will mean is I can be probably twice as effective at my job, which makes me more useful to companies. So I've looked at the landscape and I've looked what feasibly I can earn with this additional kind of qualification. Alex, I would say it's a little bit like the kind of the corporate accounting thing you did, like a side part of your accountancy, but it's a
Yes.
little bit more niche than that.
Hmm.
And I've worked out that actually in the next kind of 2 years or so after qualifying, I could feasibly increase my salary by £20,000 per year, which is mental when you think about it. That's like a 50% raise for me just by having an additional side qualification. So obviously it's effort and work and I've got to do it, which I'd back myself to do. That's fine. But for people working in industry, just think about some perhaps niche areas of the thing you work in. Can you get trained in something like that? Ask your employer if you can reason to them that you'll be more useful. They might have a pot of funding for that. I got this funding by talking to one person, and then she linked me with someone else, and she linked me with a different person, and then hey presto, here we are. I've had to do a lot of work in the meantime, but it's you never know what can come of a conversation you have, and it's someone will know someone who knows something that you might need, and it's in the future going to be incredibly beneficial. So I mean, if I can earn an extra 20 grand a year for the next 10 years, for example, that is a lot of extra cash towards your FI number.
Hmm. Yeah, it's always a game changer, really, getting that. I think it's such good news,
It's
and
massive. Yeah.
well, congratulations on getting that set
Yeah.
up
I feel very
and
lucky
persevering. Yeah,
with it to get kind of the funding, etc. Because there's loads of people who want stuff like this. I was just more prepared, I think, for it.
yeah,
I'd done the prerequisite courses and I kind of bugged the people who needed to know in advance. And I was ready to move when the offer was there. They were like, can you do it at this point? And I'm like, yeah, I can. So,
yeah.
and I suppose being on the way to FI helps as well because there was a small time frame, like a window, where I didn't know that I would get funding for it. So I was like, actually, the course is £2,489. And I was like, actually, if I don't get funding via this method, I can actually just fund that myself, which it sets me way apart from the crowd in terms of being able to just lay your hands on that. And that the amount of money we have kind of sitting for that in cash has come from really good financial practices that we've been doing since 6 years ago or so. So I feel like it's a useful thing all the way around for that. Sorry, my dog's just walked in the room. She's breathing really heavily. I don't know if you can hear her.
She's also very excited.
Yeah, she's a bit warm,
Yeah.
I think. Yeah. So, Alex, that's my one return on heartbeats for this week. So, if you're okay with it, I'll pass to you for the main body. So, a little bit of a dive into company statements.
Yeah, absolutely. And I'm hoping it's going to be a useful exercise to go through. And I'm not going to go into loads of detail here, but I think it's important as you get more familiar with investing and the financial markets to have an appreciation that ultimately you're investing in companies, and these are businesses where people work, they make products or they sell services, and they are real living, breathing things underneath the numbers on a screen. And there's three really important fundamental financial statements that are available. And this is, I should say, for public companies. So any company listed on a stock market will produce these financial statements. And I'm just going to take a bit of time to talk through each of them, what you might use it for, what they say, what kind of things it will show you. And there's reams of study and insight and education that is available going into really like deep diving some of this. And we'll maybe do another episode on some of the kind of financial ratios and investment ratios that you might be able to pull out of these financial statements to help you with investment decisions. But I think as a starting point, I'll just talk through kind of key elements. And Alex, feel free to butt in and ask questions along the way. They're fairly complex. Just keen to make sure I get it across and explain them in an appropriate way. So any company at the end of its financial year will have to produce three core financial statements. So one is a profit and loss account, one is a balance sheet, and one is a cash flow statement. They often, well, all of them will come in the form of like an annual report. And if you're interested in reading or learning more about a company, the annual report is actually a really good way of finding out about a particular company. They usually run to a couple of hundred pages. There's a lot of information in there. You'll get reports from the chief executive, the chairman. You'll get usually big businesses are separated into different segments. So we're talking about like Unilever or P&G earlier. They might have a like food section or toiletry section or something else, and that's a division of the business. And they will produce kind of the directors of that area will give you an update within that. So you get a really good feel about how the business is performing, its kind of strategy and what it's doing. And then towards the back, the chief financial officer will also write a letter and give you an overview as well, like a report from them. Then towards the back, you will see the financial statements, and they usually the balance sheet, P&L, and the cash flow statement are 1 page each. They're within a section which probably contains about anywhere from 50 to 100 pages, because underneath all of it there are notes to the financial statements. For now, we'll just focus on what each of the reports actually does and what it tells you, and we'll go from there. So the first element is the profit and loss account. You might hear it called the P&L or statement of profit and loss or operating income statement or income statement. There's several names for it, but by and large, it's showing you for the last 12 months how the business has performed financially. So that is showing you the revenue that is made. It's the cost of earning that revenue, and it's split into two is the costs. So one is the what you call cost of sales. So that's costs which are purely involved in almost the purchase of raw materials or paying particular um, suppliers or particular people within your business that directly correlate to the revenue. And then after that, you'll have like gross profit. And you'll often hear, if you read the press or read any news articles, like something like gross profit or gross profit margins, that's come from the profit or loss account. You want a business that is profitable. Generally, the higher the gross profit margin, the better. You then have got operating expenses. So these are all of the things which are a business incurs these costs. They're often under operating costs, and they are needed in order to support the core business. So, for an example, if you're a car manufacturer, so you manufacture cars, the cost of the metal and tires and seats will all be in that cost of sale line, as well as the people that work on the front line putting the putting the nuts and bolts together. The operating cost would be, say, somebody in the legal department or somebody in the finance department. So you can't really attribute that work to a sale. So it's but it is needed in order for the business to operate. And there's also in there's we'll have, so you deduct your operating expenses and you then come to your like operating profit or net income. And sometimes it's called EBITDA, so earnings before interest, tax, depreciation, and amortization. And if you read the press and you read articles, you'll often see EBITDA quoted a lot. So that's in effect a kind of net income, and it's trying to show the cost. It's as close to cash profits as you can probably get is EBITDA. So that comes from your P&L. And then there are adjustments for depreciation and also then interest that's payable on your tax. Interest, sorry, that's payable on any debts that you have. And then also tax, so any tax that you pay. And at the bottom, you'll then get your not like net profit, which is the profit available for shareholders and profit available for the company to either reinvest or distribute or pay as a dividend. And the that number will be your earnings, and it'll be the earnings per share. And you might see, yeah, that EPS quoted in some of the write-ups, or if you look on like Yahoo Finance, EPS is there. So earnings per share, so that's taking your net income and the net profit for that year. How many shares have I got issued? And one divided by the other gives you that earnings per share. So you want a company that's growing earnings per share. You want one that's as that the profit margin is increasing. But that P&L, see it as almost your performance for that year in isolation. And it's a little bit like when you do your almost like the way I see it is like your tax return in a way that as an individual you earn income from jobs or from rental properties or from stocks and dividends. That's income, so that's your revenue, and then you'll have to kind of pay out tax within that year. So, but it's only that year that you then pay tax. You go to the next tax year, and you start again. And the P&L works in the same way. So year two, it starts at zero, and then you kind of generate revenue and incur costs, etc. to do that. So that's the P&L. The other financial statement that you will find is a balance sheet, and this is a cumulative financial statement. And so this from the day that the company has been incorporated, you're going to be it will buying assets, it will be incurring liabilities, and the balance sheet keeps score and it's the cumulative position of a business, and it shows what does the company own and what does the company owe, and therefore what do the shareholders of that business own within that company. And the balance sheet is called that because it balances. So if you have your your assets less your liabilities equals your shareholders' equity. And so it covers kind of three main components. There's a balance sheet. So one is assets, one is liabilities, and one is equity. On the assets, and this is, I also look at this in the way that, like when I wrote my book, one of the first things I said people should do is calculate their own balance sheet. And this is and essentially looking at everything that you owe, everything that you own, and what's the difference. And you want to have a net asset position. And those of you that we're all pursuing financial independence, our net asset position or net worth, want of a better word, we would like to see increase year over year. And a company works in pretty much the same way. So the company will have assets. So that could be, think of a car company, they'll have machines, they'll have inventory, they'll have buildings, they'll have factories. So those are the assets. As well as that, they might have cash. Quite a lot of companies have got actually investments, and they hold their own investment kind of portfolios. Or what you will see is investment portfolio is probably the wrong word. They will have equity-like instruments, or you'd be able to. They'll have government bonds that they'll own as well as cash, and then a company you'll also see will have like receivables as their assets. So accounts receivable is known as. So this is where, if you often in business, when you make a sale, the customer doesn't pay you straight away. They'll usually pay you within about 30 days, potentially, 30 days, 60 days, 90 days, 180 days. So you know that you've got that money coming to you, but you don't actually have the cash. So on the balance sheet, you will see accounts receivable, and that's usually a fairly big number. So and then you add all that up, and that's the assets for that business. The liabilities, so this is everything a company would owe. So this can be from bank debt. So they might have borrowed bank debt, they might have issued bonds into the market, or bond investors. They will also have suppliers. So you're going to be buying supplies from people, and you will, again, the same way that you don't get paid immediately, you get paid after time. You pay your suppliers, again, usually 30, 60, 90 days, maybe a year if you're a big supermarket. And so those are some of the things that you're going to be owing out. And there's a few other bits in there, but those are kind of the main elements. And so you will have your liabilities, and then your assets, and then you have your equity. And so your assets minus your liabilities gives you your equity, and that is what the shareholders of that business will own. So within that, you'll often see there's share capital and there's often share premium. So if a company has issued new shares, people buy them at a premium, and then that goes into that equity pot. And there's also retained earnings in there as well. So all of the cumulative years of trading, the earnings, whether they be profits or whether they be losses, the cumulative balance of those will sit in like the equity portion of that. So you will see if you see the term net asset value, which is often a fairly common like investment metric. So the net asset value of a company is if you were to buy all the asset, you buy the company, sell the assets, pay off the liabilities, what you're left with is that net asset bucket. And often in there you will see like book value. So that's the book value is the same as the net asset value. And if you're looking at investing in specific companies, some of them will be quite close to their book values. Some will be quite more expensive than their book values. But that's the term that it's referring to, is almost you sell everything, pay it all off, that's what you're left with. So that's a balance sheet, and it's done at a point in time. So it's done as of the end of the financial year for that company. This is everything it owned and owed. The final statement, which is for me is the one I always look at mostly, is the cash flow statement. because there's a lot of accounting adjustments that can go into the P&L and the balance sheet, the cash flow you can't do. There's not as many accounting adjustments, and you can't operate as much in a grey area as you can. You can operate in a bit of a grey area with some of those adjustments. You can't do that with cash. And the cash, what that cash flow statement does is really bring to life the cash that's going in and out of a business. So it'd be and it's split into three sections. So you'll have your cash flow from operations. So that's your day-to-day running of the business. So how much cash do you get in from sales? What are you paying out? Are you paying out to your suppliers and paying out for taxes and things? So those that's almost from the day-to-day operations. How much cash am I actually generating? There's then a section on cash from investing activities. So from a business, they might invest in, because you'll be left with cash at the year end, you might buy new machinery or expand a factory. You may buy another company, to your point at the top of the call, Alex. You may pay a dividend out, or you may buy back your own shares, but that's showing you what the business is doing to invest in itself and to return money to shareholders. And then there's also cash from financing activity. So this usually covers if the company has raised more money, so they've either done a share issue, or if they've paid off debt, or if they've raised more debt and got into more debt, that will be covered in that section. And all of the three financial statements talk to each other, but you want to be looking at companies if you look at what Warren Buffett kind of has as his investment philosophy, he puts free cash flow as the highest priority in terms of what he looks at as a business. They are there to generate cash, and you want a business that's going to be generating a lot of cash flow. And so you want companies which are, they're generating lots of cash flow. It doesn't take a load of investment to keep the business running. And so if you are let's just say, a self-storage business or a car park, for example, once you've bought that big storage unit or the car park, yes, it costs a lot of money up front, but the ongoing cost of that is really minimal. But you can still continue to charge a lot of money, and you therefore generate a lot of cash from that business. If you compare that to, say, a big utility company, which has got to invest millions and millions and millions of pounds every year to just maintain the infrastructure. So if it's Thames Water might be a very bad example, or a good example of a company that should be doing it but hasn't been doing it. To maintain a service, you need to invest a lot in the underlying infrastructure that supports that service. Therefore, it's we call it like capex heavy, and as a result, you then don't get as much cash flow. So when you start looking at companies and you get under the skin of them, these financial statements are really helpful in giving you that insight. With any kind of financial statement, doing it just in 1 year, you need to look at them for a good couple of years to get an idea of where they're trending. And there's often software that's available to disseminate this, and as well as some of the ratios. But industry dynamics are also very important. So some industries will have very set profit margin, very high profit margins, others won't. It's not very sensible to compare a very profitable software company to think of a very low margin business, maybe a supermarket, where they might earn incredibly low amounts of profit, but they sell a load, so therefore they make up for it in that way. But you would never compare the two. So yeah, just being mindful of that. And yeah, all the annual reports are available on company's website. So if you are keen to have a look at, even if look at the company that you work for, they're often really interesting and insightful. Potentially, if you've got a job offer from somewhere, or you're looking to work somewhere, having a quick look at their annual report, financial statements, can give you a good insight into the financial health of that business. So maybe a key consideration of whether or not you'd want to kind of move into that business. So loads of ways to use them. They do take a bit of getting used to. There's a lot of acronyms and often a lot of different terminology, and several terms can mean the same thing. But for me, it's about familiarizing yourself with it. And I think I can't remember who had said it exactly, but it's almost like accounting is like the language of business. So like if you can understand and read balance sheets and P&Ls and cash flow statements, you are so much further ahead than most people when it comes to understanding businesses. And that's not saying you need to be a chartered accountant, but just having that level of understanding of what they do, why they're there, then they're really valuable tools. And just finally, I should say every company that's on the stock market has got to publish annual reports. They are all audited, other financial statements. So you will have auditors they come into your office and will test your systems to make sure that what should be getting produced is getting produced. In terms of, if you pay an invoice, does that then show that that paid invoice drops off your system, it goes out of your bank account, and therefore they give them comfort that what you are producing as a company reflects the business. So you can take some comfort that the numbers have been checked, or I should say the way that the numbers are produced has been verified and checked. So quite a lot there, but I think those are a bit of an overview of the three financial statements and where to find them. And if there's people who are interested, let us know, and I can happily go into a bit more detail on some of the key ratios that you might look for to try and spot what differentiates a good company versus a bad company using these financial statements.
Yeah, so I've just been sitting. I don't know anything about this kind of stuff, as you can probably tell, but I've been sitting kind of making notes. So, firstly, it is our pal Warren Buffett who said accounting is the language of business in a CNBC interview in 2015, according to a quick Google.
Brilliant, thank you. Fact
Yeah,
check.
yeah, that's it. I just do it on the fly as we go, and I just like it makes sense. And one of the things I was thinking about is, when big companies all of a sudden they're like, oh my god, we're bankrupt, we're done. My initial thought is like, how can you, as a company, not see this coming? But if you think about how transient all that stuff is, so you mentioned a little bit about kind of on balance sheets and profit and loss and kind of annual reports and cash flow statements, etc. But it's like the ebb and flow of business. You might make some money or sell some products in, say, January, but not get paid for that until July, August, potentially the following year. So you have to have something, either a consistent method of selling and bringing in income and then paying suppliers. And all of that has to work and flow. So I don't think I fully realised how many people would be involved in something like that. Like, for example, for Sainsbury's, say, supermarket, you're not just going to have one accountant, are you?
Oh, the team will be hundreds of people.
Yeah, that's madness, isn't it?
Their finance team will be massive. Yeah.
Yeah, and it's not just people bring in food and people buy food, and therefore you buy an apple for 10p each and you sell it for 90 pence and you've made 80p, etc. But it's kind of getting it there. It's the cold chain of getting it there. It's making sure your numbers stack up. It's having people to load it, unload it, put it where it needs to be. And there's a lot of organisation that kind of goes on. So I didn't realise the depth of that. And actually, if you don't have enough, say, like when you said Warren Buffett talks about the free cash flow, it's having some cash on hand for stuff that happens that you can't predict. So say you're expecting loads of coffee beans, for example, from Ethiopia or wherever, and for some reason there's some kind of drought or issue or bacteria, bug or whatever that just prevents that from happening. You have to have a plan B, C, and D, and then pivot your business and kind of thing that. And I don't remember ever or rarely, especially kind of during COVID, rarely seeing supermarket shelves totally empty of things. So the supply of that is consistent, the demand for it's consistent, which means everything else underneath that also has to be consistent. Otherwise, you don't get a business that started in 1920 something or earlier, still running over 100 years later.
That's it. And I think, they are really complex systems of people, and different suppliers in different countries, and there's so many risks around supply chain, and more so now than, with, you look how almost globalized we are, but how fractious I guess the international political landscape is. There's a lot of risk in getting things to and from places, and making sure that your logistics are top notch, and there's so many considerations. And that's selling pre-packaged food or whatever. But if you've got really complex and, I guess, products which require really high levels of, might need sign off, or I think of like medicines and things, like there's so many, again, just another dimension which just makes this whole beast so much more complex. And yeah, when it's like you said about, how do companies know they're going bankrupt? A lot, you go bankrupt because you run out of money, and there's so many factors that can lead to that. But ultimately, if you're not earning enough money from your products and your sales, and you're having to borrow money, there's a point where the banks stop the banks stop lending, and your debts suddenly become much larger than your business, and you've got debt repayments, and you've got interest payments, and you can't refinance, but your underlying business isn't working that well and not generating enough money to pay it off. It's a bit like if an individual goes into too much debt, and you've got 2 or 3 car payments, and you've overstretched on your mortgage on the assumption that your income is never going to change or will only go up, and then you have a job loss, or there's a restructure, or something happens, and you've almost maxed out and redlined on your borrowing, and that the thing that should be paying all your bills is now gone or has severely reduced. And it's similar with companies.
Yeah, just on a much bigger scale. I mean,
Yeah.
we've talked a lot about obviously personal finance, being a personal finance podcast,
Yeah.
but if you extrapolate that out to businesses, that's why a lot of like self-employed people, their business doesn't last, I think, longer than 2 years or something in some cases, and it's rare to have something that is profitable. You can make work that does kind of sustain itself over time.
Yeah.
But
It's really
it's
rare.
rare, and it's difficult. Yeah,
Yeah.
for sure. And if you think about, like, a good example of this is like in medicine where I work at the minute in ADHD, there's a medicine that's made by a Japanese company that's shipped from Japan to America to somewhere in Europe, back to Japan to be made, to be reshipped across the world. And there's been some tariff issues recently, and they're missing one of the ingredients for this particular medicine, and it's out of stock absolutely everywhere. And there's no equivalent of it, so they've got a literal stranglehold on it while they can produce it. But if one thing of that thing, the ingredients list or the supply chain changes, like you can't. This isn't a swap butter for margarine and shove it back out thing. It must be accurate. It must be in the correct dosage. It must be wrapped in a certain way, and then sent everywhere. And we get loads of people phoning me and my kind of colleagues, and they're like, "I can't get it," and I'm like, "Well, if you can't get it, I can't get it. I don't have any. You just have to wait. You could try X, Y, and Z, but it's not quite the same." And it just shows me kind of how delicate and like fragile those things are. And another good example of that is like the petrol strikes, when people are panicking and they're filling up all of their cars and extra tanks and stuff, and actually it's too much demand for the market and the reserves that they have. And then we start to see not an unraveling of society, but it's a little bit, it's more difficult. And it's the unpredictable stuff. So to bring this back to like personal finance wise, we want anybody listening to this and ourselves, like as a collective, we want you to be able to weather these storms and to really think about, is your financial house, are your finances in a good enough place to weather some of the stuff that you just can't see coming?
Yeah, absolutely.
Yeah. Okay. I think, Alex, that's very frankly, well, I've learned an awful lot about it. And it's certainly, if someone does want to dig into like stock picking, etc., this is the kind of stuff when someone says do your diligence on said company, it's this kind of thing that they're talking about. And Alex, we'll come back and we'll do another kind of company statements too or something.
Yeah, absolutely.
About a bit more into something like that, because it's something that I don't know about. Yeah. But for now, quick reasonable or ridiculous, and then a quick summary, because we've gone 40 minutes so far.
Reasonable or ridiculous?
It's boiling hot in England. I'm melting virtually every day. So my reasonable or ridiculous for you today is it one or the other to have air conditioning fitted in your house?
I mean, sat right now is I think it's incredibly reasonable. I'm absolutely boiling. I'm boiling hot. I have no idea how much it costs or anything, but because part of me thinks, yeah, I'd love the comfort. The other part of me is I don't really know what needs to be done to the house, how much it costs, and for maybe 2-3 weeks in the year, is it worth it? I'm not sure, but based on my incredibly sweaty back and everything that I'm sat in my boiling hot office, I would, yes, if I had air conditioning, it would be on.
You'd 100% turn it on. So I did a tiny bit of research into this last week. It costs about roughly between £2,000 and £3,000, right, to install. No idea about ongoing costs. You have to have one of these big boxes and fans on the outside of your house somewhere. You see it in big businesses and stuff, but I know very few people, like probably less than 3, that have air conditioning for their home or house.
Yeah.
But if you think about it, every car I've owned pretty much in the last 10 years has had air conditioning, various stages of it working or not. For me, this summer, air conditioning has been an absolute prerequisite. So my car doesn't have it. My wife's car does. I will use her car when I can because it's much more comfortable to have it. But I don't know if perhaps with global warming, etc., whether we revisit this in 10 years and we're like, how did we ever live without air conditioning?
Yeah, maybe that's it.
It depends on your climate, how close you are to the equator, etc. Okay, so you're saying currently it's reasonable, but for the most of the year, not reasonable.
Yeah, I'm very much on the fence.
Yeah, me too.
If I'm honest,
I might ask you again in winter. I think
I'm probably borderline no, because I could maybe just go into the office and use their air conditioning, but for the day.
But, rent it for the working week.
Rent it out, exactly.
Yeah, could be another perk of the job, right?
It's a difficult one.
Yeah, it is. It's transient, depending on the month. And how you feel.
That's it. Ask me in January.
That's it. You're like, absolutely not. Waste of time.
Yeah.
If you put £3,000 into your investment portfolio in 10 years, it'll equal this.
Yeah.
Okay, right. Quick summary then. Firstly, I'm halfway through reading a book called The Myth of Capitalism. It's decent. In terms of return on heartbeats, I asked some questions to some people. I've been given very fortunate answers. I've got 6 months of solid effort work university to put in. After I've done all of that, within a couple of 2 years, it'll lead to a healthy looking pay rise, which will really help me and my wife and our life and our journey towards FI. Alex, you've spoken about company statements, including annual reports, so the profit margins, cost of business health, profit and loss, whether the company is solvent or not, is it growing or is it shrinking, the balance sheet or the scorekeeping, assets versus liabilities and versus equity, the blend of where we're at, where companies are at, and finally the cash flow statement, which you think is the kind of the most important. And Warren Buffett thinks the amount of free cash flow is one of the most important aspects of the health of a business. We've talked about whether we think air conditioning in the UK is reasonable or not. Currently, we're still, I think, on balance saying no, but ask us again in 10 years and we might think differently. As a result of that as well, I've been buying a fair few more linen clothes to kind of keep me cool. True good quality linen is very breezy. So actually, I'd rather spend some extra money on linen clothes than I think £3,000 on house air conditioning. And that, I think, is my summary for episode 69, company statements. Is there anything more you would like to add?
No, I think that's a brilliant summary. And if there's any questions or comments from our listeners, please get in touch. Happy to have another episode on this type of thing.
Yeah, absolutely. We'll definitely bring that back. In other news, I'm going to bring back Joel Miller, who's the financial planner from Flames Financial Planning. He's a bit kind of a disruptor in the industry because he doesn't charge assets under management fees. He does advice as and when and a monthly subscription. So at some point we'll have a part 2 with him. But Alex, thank you for your time, my friend. Just a good tip here on sleeping whilst it's really warm. If you dip your feet in cold water and you run your wrists under cold water, it helps cool your blood and therefore your body temperature. And your internal core temperature needs to cool by 2 degrees for you to fall asleep. So if you struggle, try that.
Ah, well, thank you for that tip.
You're welcome. A little bit of biology. And with that, my friend, I'll see you next week.
Yes, see you next week.
None of what we discuss on the show is to be considered financial or health advice, and we recommend you always do your own research or consult an independent financial advisor or a doctor when making your financial or health decisions.